Welcome to the Deep Dive. We're the show that takes those complex topics and really tries to break them down into insights you can actually use. Today, we're diving into something that, well, touches almost everyone, taxes, but specifically, part that often feels like a maze, itemized deductions. We're going to zero in on the rules for deducting interest, the interest you pay on mortgages and maybe even investments. And these are deductions from AGI, adjusted gross income. That's a really key difference we'll unpack. Now, if you've been with us, you might remember our deep dives on things like medical expenses or taxes paid. This piece today slots right in, adding another layer to that picture. And stay tuned because we'll keep building this out, looking at things like charitable contributions down the road. Okay, before we get deeper into the weeds, just a quick reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations are derived from the fantastic accounting resources over at farhatlectures.com. So whether you're maybe an accounting student, studying for the CPA exam, or already a professional, definitely check out the website.
They've got extra practice questions, video lectures, tons of support to really cement what we talk about today. A big thank you to Professor Farhat for making this material available. All right, so our mission today, let's get through the complexity around interest deductions. We want to give you a kind of shortcut, really, to understanding what qualifies, why it qualifies, and how you can navigate this without feeling totally overwhelmed. Okay, let's unpack this. So just to set the stage again, itemized deductions. These are generally personal expenses, right? Not for running a business. And you claim them from AGI on your Form 1040. And every year you face this fundamental choice. Take the standard deduction, the flat amount the government gives, or add up all your eligible itemized expenses. But here's the kicker. Itemizing only helps your tax bill if your total itemized deductions are more than the standard deduction. It's not just about having the expenses, it's about having enough. And this whole calculation really shifted after the Tax Cuts and Jobs Act of 2017, the TCJA. That law massively increased the standard deduction amounts. It made the bar much, much higher to clear for itemizing. Plus, it suspended a whole bunch of miscellaneous itemized deductions, think unreimbursed employee costs, some investment expenses from 2018 through 2025. So the standard deduction isn't just the easy route anymore. For a lot of people, it's actually the better financial choice now. It really changes the game.
It really does. That higher standard deduction means even homeowners might find they don't benefit from itemizing anymore, which was pretty uncommon before. And when we talk specifically about interest, the rules get pretty specific depending on the type of interest. It's interesting how different kinds are treated, like your everyday personal interest, credit cards, personal loans, car loans generally. Nope, not deductible. There's no tax break for carrying that kind of debt. But there is a big exception. Student loan interest. That's technically personal interest, but it gets special treatment. It's deductible for AGI, not from AGI like the ones we're focusing on today. It has its own rules and limits, of course, but the idea is to encourage education, especially maybe for people who don't yet own homes or have lots of other deductions.
Okay, so student loans are kind of their own category, deductible for AGI. But what about the interest related to homes? That's where qualified residence interest comes in as a from AGI itemized deduction. And we also need to talk about points you might pay on a loan and the rules for investment interest. This is where it gets really interesting, especially if you own a home or invest. Let's start with that qualified residence interest. For many homeowners, this is, well, the biggest itemized deduction they might have. But what counts as a qualified residence? It's your main home where you live most of the time, plus one other home that you don't rent out. So yeah, potentially interest on two homes. But the key is the debt has to be secured by those properties. It needs to be a mortgage, essentially.
Exactly. And here's a critical point. What the loan money was used for. The debt must have been used specifically to buy the home or to make substantial improvements to it. And substantial improvements means, big stuff. Adding a room, putting in a pool, a major kitchen remodel. Not just fixing a leaky faucet. This is where rules got tighter. If you took out a home loan, say a second mortgage, but used the cash to buy a car or go on a big trip or pay college tuition, the interest on that part of the loan generally isn't deductible right now. That used to be possible before the TCJA, but not anymore, at least for this period.
Right, that brings up the idea of equity. Let's say your home is worth $600,000 and you owe $400,000 on the mortgage. That $200,000 difference, that's your equity. And historically, people often borrowed against that equity for all sorts of things, and the interest was deductible, like you said, taking out a home equity loan for a car. But the TCJA changed that.
Absolutely. The TCJA put new limits on the amount of debt you could deduct interest on. Before that law, specifically for debt taken out on or before December 15th, 2017, you could deduct interest on up to $1 million of acquisition debt. That's debt used to buy, build, or substantially improve the home, $500,000 if married filing separately. But for debt taken out after that date, from 2018 through 2025, that limit dropped to $750,000. So if you took out a $900,000 mortgage in, say, 2019, you can only deduct the interest on the first $750,000 of that loan during these years. There was a lot of talk initially that the deduction was disappearing completely, but that wasn't it. The limit just changed. And interestingly, it's set to go back up to $1 million after 2025.
Okay, so that $750,000 cap is a big deal, especially in higher cost areas. And that leads us right into home equity loans, or lines of credit ELOSIS. These are basically second mortgages, borrowing against that equity we talked about. Now, before 2018, and scheduled again after 2025, the interest on these was often deductible, even if you use the money for personal stuff, like that vacation. But, and this is the crucial part for right now, 2018-2025, the interest on an ELOSIC is only deductible if you use the borrowed funds to, again, buy, build, or substantially improve your qualified residence. So using your ELOC for debt consolidation or that Caribbean cruise. No interest deduction for that portion during these years.
That's the key distinction right now. Let's use an example. Say John has a house. His main mortgage is $550,000. He takes out a $100,000 Halo C. If he uses that entire $100,000 to completely renovate his kitchen, a substantial improvement, then the interest on that $100,000 ELOC is deductible. Why? Because his total debt, $550K plus $100K plus $650K, is under the $750K limit, and the ELOC funds were used for a qualified purpose, improving the home. But same $100,000 ELOC if John used it to buy a boat. During this 2018-2025 window, the interest on that ELOC would not be deductible. It all boils down to the use of the funds. And remember, that $750,000 limit applies to the combined total of your first mortgage and any home equity debt used for acquisition or improvement.
Got it. That use of funds rule for ELOCs is really critical right now. Okay, let's switch slightly to something called points. You sometimes see these on loan closing statements. What are they? Basically, fees you pay upfront to the lender, often to get a lower interest rate on the loan over its life. You're kind of buying down the rate. The important thing for taxes is whether these points count as interest versus just a service fee.
Right. And here's the difference. If the points are paid when you acquire or improve your main home, you can often deduct the full amount of the points in the year you paid them. That's a nice upfront deduction. It can significantly lower your taxable income in that specific year, but it's different if the points are paid for refinancing an existing mortgage. Refinancing just means replacing your old loan with a new one, usually for a better rate, not buying or improving the home itself. In that case, the points generally have to be capitalized and amortized. That means you deduct them slowly, spread out over the life of the new loan. So if John refinances and pays, say, $3,200 in points on a 30-year loan, he doesn't get a $3,200 deduction up front. He might only deduct a little over $100 each year. It stretches the benefit out.
That's a huge difference in timing for the deduction. Okay, one more thing related to mortgages. Prepayment penalties. What are those about? Sometimes, if you pay off your mortgage way earlier than planned, the lender might charge you a fee. It's to make it for the interest they expected to earn. So is that fee deductible?
Generally, yes. The IRS usually treats a prepayment penalty as interest, so it follows the same rules. If it's a penalty for prepaying your qualified residence mortgage, then yes, it should be deductible as itemized interest. If it was for, say, prepaying a personal car loan early, then no, just like the original interest wouldn't be. It connects back to the loan's purpose.
Okay, good to know. Now let's shift away from homes and talk about borrowing money specifically to make investments. Think using a margin loan to buy stocks. Congress puts limits on deducting this kind of interest. The thinking is, maybe, that allowing unlimited deductions could encourage people to take on too much investment risk with borrowed money.
Exactly. The main rule here is that your deduction for investment interest expense is limited to your net investment income for the year. What's net investment income? It's things like your taxable interest, ordinary dividends, certain royalties, and net short-term capital gains. It generally doesn't include long-term capital gains or qualified dividends unless you specifically elect to treat them as investment income, which has other consequences. So let's say you paid $10,000 in interest on margin loans, but you only had $3,000 of net investment income, like dividends and interest. You can only deduct $3,000 of that interest expense in that year. The remaining $7,000 isn't necessarily lost forever, though. It usually gets carried forward to future years, where you can deduct it if you have enough net investment income then. And there's a key exception here, too. You absolutely cannot deduct interest on debt used to buy or carry tax-exempt securities like municipal bonds. The logic is pretty simple. If the income the investment produces isn't taxed, you shouldn't get a deduction for the cost of borrowing to earn that income. It prevents a double benefit.
That makes sense. Let's use Jane as an example. Say she borrowed $10,000 to buy stocks, paying 8% interest, so $800 a year. If she earned $1,000 in dividends, her net investment income, her $800 interest expense is fully deductible because it's less than her investment income. But what if her interest expense was $1,200 and her investment income was still only $1,000? She could only deduct $1,000 of the interest that year. The extra $200 would carry forward. And like all of these deductions we've discussed, the mortgage interest, the points, this investment interest, you only get the benefit if you actually itemize on Schedule A. If your total itemized deductions don't beat the standard deduction, or if you just choose to take the standard deduction, then you don't get to claim any of these specific interest deductions separately. That standard versus itemized choice is always the first hurdle.
Wow. Okay, we've definitely covered a lot of ground today, from the basics of itemized deductions versus the standard deduction through the complexities of qualified residence interest, HLOCs, points, prepayment penalties, and finally investment interest. It's quite a journey through the tax code's rules on interest.
I think the big takeaway is that while these itemized deductions can be really valuable, they only actually save you money if they add up to more than your standard deduction amount. And knowing the specific rules, especially those tricky ones around how loan money is used or the limits based on when debt was incurred, is crucial not just for tax time, but maybe for planning big financial moves too. So here's something to think about. Now that you have a better handle on these rules, how might that knowledge actually empower you? How could it change how you think about borrowing decisions, maybe buying a home, refinancing, or even your investment strategy? Really makes you consider the tax angle on those big life decisions, doesn't it? Thanks so much for joining us for this deep dive. We hope it sheds some light on a complex area. We'll be back soon with another topic to unpack.